Insurance knowledge. Hi, my name is Abahi and I am a claims adjuster. Let's get into it so you can pass your property and casualty test. The course agenda for today is what is a contract, what is the inception/expiration date, which will be on the test. We'll go over loss description, date of loss, how the deductible works, and what a tort/joint tortfeasors are. First, you need to understand on the test you are going to be asked what is a policy like. An insurance policy can also be called a what? The answer to that is going to be a contract of insurance between the insurer and the policyholder. So what I would like you to do is take a second to locate each of the following. The inception date on the test will ask you how long does the policy last. It can begin on any date, but how long does it last? For the test, it's 1 year from the date of inception. That's how long the average homeowner policy lasts. For auto, it may be 6 months. If you want to know the time, the inception time is 12:01. That way they know exactly what time to start coverage. This is important because if a fire happens at 12:02, you may be out of luck if you missed your payment. Okay, so have you located the inception date or the inception time? Have you located which policy form? Your policy number is a unique number. Coverages, that is going to be covered on your course as well as it will appear on the exam. You have 4 different coverages. We talk about that in a different video. There's A, B, C, and D under section 1. Under section 2 you have E and F, so the liability sections. The liability sections do not have deductibles. That's our next bullet point. They do not have deductibles on section 2 liability. You do have deductibles on section 1, and you can see sometimes your insurance company gives you 2 different deductibles even though they're the same amount. You do want to be careful when shopping for insurance that you don't have a percentage, but you have a fixed deductible. We'll go over the different types of deductibles. The named insured is important because that's the person that they're going to speak to. They are not going to speak to anyone not on the policy about this policy. So if you have more than one person on the policy, it's the first person. They are the named insured, and you also have on the test first named insured. That will be the person who will receive communication first. Now, the description of loss is not on. Oh, the description of loss is what it is actually. It's like, is it a home? Is it a car? So, or really description of risk, it should say. Locate the following. Okay, so the inception date. So you see that? 1 year. 1 year. The inception time, 12:01. That is going to be on your test. It's 12:01 a.m. wherever the property is located. Policy form, you'd have to know if it's a HO3. It's usually going to be before the policy number. Your coverages. Again, we went over that. It's number 9. Your deductibles, number 8. Named insured is up at the top, and then the description of the loss. That's the description of risk. That's where it's located, not the description of loss. Because a description of loss simply states what location is being insured. The date of loss is also known as the date of the occurrence, or DOL. Date of loss. Let's hear what a deductible is.
Insurance deductibles explained. Insurance is all about protecting your assets from risk, so you don't get stuck paying through the nose after an accident. But before insurance kicks in to save your nose, your deductible is the portion you pay out of pocket. Let's break it down. Say your deductible is $500 and your repair bill is $2,500. You only pay your deductible amount, $500, and the insurance pays the remaining $2,000. Deductibles and monthly premiums. When one goes up, the other generally goes down. The appeal of a lower monthly premium comes with the price of a higher deductible, which could ding you after an accident. So set your deductible at an amount you're willing and able to pay if the time comes.
with Geico. I had an interview at Geico one time. I have a video recapping my experience. All right, I don't think that was enough about deductibles. That was a little quickie video to get your eyes watering for more. So here's another deductible video.
Deductibles are a vital component of any insurance policy. But what is a deductible? How does it work? And how does it benefit me? First, we need to understand the purpose of an insurance policy. An insurance policy is an agreement between you and the insurance company. You agree to pay a premium for the coverage and protection provided by the policy, and in exchange, the insurance company agrees to pay for losses covered by the policy, such as fire damage. Insurance policies are not meant to cover small losses, or what some call maintenance-type losses. They're meant to protect you from the financial devastation that can occur when you have a large loss involving your home, auto, or business. That's why insurance policies include a deductible. The deductible is the portion of the loss you'll be responsible for, the amount you have to cover out of your own pocket when a loss occurs. If you're like most people, you don't have enough money saved up to replace or rebuild large assets after an unforeseeable catastrophic loss, such as losing your home or business and everything inside to a tornado or fire. On the other hand, you could probably afford to pay for a few $100s out of pocket to repair minor damages. By avoiding the smaller losses, your insurance company can offer you coverage at a lower rate and still protect you from larger, financially devastating losses. Another aspect of deductibles that can be confusing is when they apply. For medical insurance, you typically meet a certain deductible amount for the year. Once met, the deductible no longer applies for the rest of the year. With just about every other type of insurance, including auto, home, and business, the deductible applies separately to each claim. Let's say heavy winds damage your roof. If the damage is covered by your policy, your insurance company will pay for the loss minus your deductible. If you have a covered fire loss later that same year, your insurance company would once again pay for the loss minus your deductible. The important thing to remember about deductibles is the higher your deductible, the lower your insurance premiums. Because you are assuming more of the risk yourself and not relying entirely on the insurance company to pay for everything, they are willing to sell you your policy for less. Ultimately, when deciding which deductible amount to choose, you have to decide how much you're comfortable paying out of your own pocket in the event of a loss. Ask your local independent agent to help you decide which deductible option is right for you.
Now that we talked about deductibles, let's see the three types of deductibles. Remember, we saw that percentage deductible was, I think, 1% of coverage A, and that's how they work, coverages. They just take one from the other, okay? So let's talk about a fixed deductible. A fixed deductible is one specific, predetermined amount that a policyholder must pay out of pocket before he can be indemnified. That means made whole. Let's look at this example. Let's say Tom's car suffers $3,500 worth of damage, and he has a $500 fixed deductible on his auto policy. Tom will receive $3,000 from the insurance company because of his fixed deductible. So they want you to pay that to however you pay it to get the work done. Percentage deductibles require the insured party to pay a deductible equal to the percentage of the value of the insured risk. Remember, I was just telling you about that percentage? For instance, if Georgia insures her house for $500,000 and the deductible on the policy is set at 3%, her deductible is $15,000. This means that Georgia is responsible for paying the first $15,000 of a damage claim before the insurance company will pay the rest. If the damage on Georgia's home is less than $15,000, she's responsible for 100% of the damages. Some policies will use a combination of fixed and percentage deductibles. An insurer may allow a $500 fixed deductible for fire and hail damage, but charge a percentage or require a percentage for wind, tornado damage. Wind and tornado damage. Your franchise deductible states that the policyholder only pays for damages that are less than his deductible. If the cost of damages equal or exceeds his deductible, the insurer pays the full amount and the policyholder pays nothing. Policy kicks in only after the loss exceeds a predetermined amount. If losses are below the deductible, the insurer pays nothing. If losses are above the deductible, the insurer pays 100%. That's actually pretty cool if you can get it. If a policy comes with a franchise deductible of $1,000 and the insured item experiences $1,200 worth of damage, the insurer pays the full $1,200 and the policyholder pays nothing. If, however, the total damage of the cost to the item is $700, the policyholder pays the full amount. Franchise deductibles are seen most often in marine insurance. All right, let's do a quick self-check. What are the differences between franchise, percentage, and fixed deductible? Franchise, fixed, and percentage deductible. So percent, you're going to see a percentage sign, so that should be pretty easy. The franchise means that if it's either 100% paid for by the insurance company or 100% paid by me. The fixed deductible is the amount that I need to set aside in case I have damage. Okay, next up, we are going to go over what a tort is. A tort is a civil or private wrong giving rise to legal liability. So there's two types, which we'll go over. So a tortfeasor is somebody who commits the tort, who does the wrongdoing. Very straightforward. The tort, again, is the act that's the wrongdoing. The plaintiff, if you've ever watched court TV, is the person who brings suit against the other one. A tortfeasor is a person who commits a tort. A tort, again, is a legal term used to describe the civil wrong. This means a tortfeasor commits an action that violates a legal duty and he is sued for his actions. If there's two people, they call it joint. So really not complex, nothing crazy to have to think about. Examples of negligent torts are slip and fall accidents, car accidents, truck accidents, motorcycle accidents, pedestrian accidents, bicycle accidents, and medical malpractice. Other examples of intentional torts are assault, battery, because you do it on, you physically go do it. It's not an accident of just forgetting or not looking. This is intentional. False imprisonment, so you held somebody against their will. Conversion, intentional infliction of emotional distress, fraud/deceit, trespass, and defamation of land or property. So let's do a self-check. Name 4 types of torts. 4 types of torts. 4 types of wrongdoing. 4 types of wrongdoing. Let's look at the negligent. The negligent would be the accidents, auto, bikes, malpractice, medical malpractice. And then your other intentional torts are assault, battery, and defamation. Okay, so do yourself a favor, take this quiz. Don't forget we went over fixed deductibles, and on the test you're going to have to know that the policy lasts a year and that it begins and ends at 12:01. My name is Abahi. We do property and casualty training at majoradjusters.com, where you can get weekly study groups, help finding work, and even help working on your career. We look forward to connecting with you. My name is Abahi. I hope this has been fun for you as it was fun for me. Thank you for watching. We look forward to